If you've ever looked at investment options and seen times like index funds, mutual funds, and ETFs, and thought, what's the actual difference between these things? And why does everyone assume I should just know? You're not alone. Maybe you've been avoiding investing because every article throws around these terms like they're obvious, but nobody actually explains what they mean or which one you should choose for your situation. Here's the truth: these are just different packages for holding the same investments. It's like choosing between a bag, a box, or a basket to carry your groceries home. What matters most is what's inside, but understanding the packaging helps you make the right choice for your needs. I'm Toyin, a CPA and financial planner, and I specialize in helping women in their 40s and 50s build wealth through smart investing. Today, I'm going to break down exactly what each of these investment vehicles does, how they differ, and give you a simple framework for choosing the right one for your situation. This foundational knowledge works especially well if you're ready to build wealth systematically, which is exactly where many midlife women find themselves, regardless of your current income level. Because here's what I've discovered: once you understand these basic building blocks, investing becomes much less intimidating and much more strategic. Let me tell you about Maria, a 48-year-old project manager. She'd been putting off investing for months because every time she tried to research her options, she got overwhelmed by the terminology. Index funds are better than mutual funds, one article said. ETFs are more tax efficient, said another. Mutual funds offer professional management, claimed a third. She couldn't figure out if these were completely different types of investments or just variations on the same thing. So she did what a lot of smart women do: she kept researching instead of investing. 3 months of reading articles, watching videos, and trying to decode financial jargon. $0 invested. But Maria's situation isn't unusual. The investment industry has created an unnecessarily complex vocabulary around what are actually pretty simple concepts. Here's what Maria discovered and what I want you to understand: mutual funds, index funds, and ETFs are just different ways of packaging investments. They're all professionally managed collections of stocks, bonds, or other securities. The differences are in how they are structured, how you buy and sell them, and what you pay for them. Think of it this way: if you want to own pieces of hundreds of companies, you have three main options for packaging that ownership. You could buy individual stocks in 500 different companies, but that would require hundreds of transactions, constant monitoring, and significant expertise to maintain proper balance. Or you can buy into a fund that already owns pieces of all those companies and manages the collection for you. That's what mutual funds, index funds, and ETFs all do. They're just different approaches to creating and managing these collections. The key insight: you're not choosing between completely different investments. You're choosing between different ways to access the same underlying investments. Now, if you're feeling overwhelmed by all the investment options and want a clear roadmap for building wealth that actually fits your timeline and goals, I send out a weekly newsletter with practical strategies specifically for women in their 40s and 50s. I'll put the link below. No generic advice, just actionable steps you can implement right away. Let me show you the key difference between these three options using three simple comparisons. Trading times: when can you buy and sell? Mutual funds and index funds both work the same way. You can only buy or sell once per day after the market closes at 4 p.m. Your order gets processed at end of day price, regardless of when during the day you placed the order. ETFs are different. You can buy and sell them anytime during market hours, just like individual stocks. The price changes throughout the day based on trading activity. Annual fees. What do you pay each year? This is where the differences really add up over time. Mutual funds typically charge between 0.5% to 2% annually because you're paying for professional managers to actively pick stocks and try to beat the market. Index funds charge much less, typically 0.03% to 0.2% annually, because there's no expensive manager making decisions. The fund simply follows a market index automatically. ETFs are also very low cost, typically 0.03% to 0.75%, with broad market ETFs under 0.1%. Like index funds, most ETFs just follow an index rather than paying for active management. Management style. How are your investments chosen? Mutual funds employ professional managers who actively research companies, decide what to buy and sell, and try to beat the market's performance. You're paying those managers through the higher fees. Index funds take a completely different approach. They simply copy a market index like the S&P 500. No human decision making, no trying to outsmart the market, just automatic matching of what the index does. ETFs are mostly similar to index funds. They follow indexes automatically. Some ETFs do have active management, but the vast majority are passive index followers. The key insight: active managers have a very hard time consistently beating the market after you account for their fees. Most index funds outperform most actively managed funds over long periods. Now that you understand what each vehicle does, let me walk you through a simple decision framework that will help you choose the right one for your situation. The first question to ask yourself is: do I want the lowest possible fees? This is important because fees compound over time and can cost you tens of thousands of dollars over decades. If your answer is yes, you want the lowest fees, then we go to the next question. Do I want to be able to trade anytime during market hours? If you want trading flexibility, ETFs are your best choice. They offer very low fees. You can trade them anytime the market is open and they're tax efficient. If you don't need trading flexibility and prefer simplicity, index funds are perfect. They have the lowest fees of all. They're completely automatic and you don't have to think about market timing. Now, if your answer to that first question was no, you're willing to pay higher fees for additional services, then we ask, do I want professional management? If yes, you want professional managers actively picking stocks and trying to beat the market, then mutual funds are your choice. You pay higher fees, but you get professional management and automatic investing. If no, you don't want to pay for professional management, then you'd actually want to consider index funds anyway. They give you simplicity and low costs without paying for stock picking you don't value. The key insight here is that all these options will help you build wealth over time. The perfect choice matters much less than actually choosing one and getting started consistently investing. The cost comparison that affects your wealth. Let's talk about what really matters for building wealth: costs. Every fund charges an annual fee called an expense ratio, which is expressed as a percentage of your investment. Think of it as the fund's annual management fee. If you have $10,000 invested in the fund with a 1% expense ratio, you pay $100 that year in fees. These fees are automatically deducted from your investment returns, so you don't write a separate check. But they definitely impact how much your money grows over time. Actively managed mutual funds typically charge between 0.5% and 2% annually in expense ratios. Index funds usually charge between 0.03% and 0.2%. ETFs generally range from 0.03% to 0.75%, with most broad market ETFs under 0.1%. Here's why this matters. On a $100,000 investment, the difference between a 1% expense ratio and a 0.1% expense ratio is $900 per year. Over 20 years, assuming 7% returns, the difference compounds to over $50,000. For women in their 40s and 50s with 15 to 20 years until retirement, Fee efficiency can make the difference between a comfortable retirement and a truly wealthy one. But cost isn't everything. A slightly higher cost fund that you actually stick with is better than a lower cost fund that makes you nervous and causes you to make emotional decisions. The tax efficiency factor. ETFs generally offer the best tax efficiency due to their structure. They can eliminate most capital gain distributions that would otherwise create taxable events in your non retirement accounts. Index funds are typically more tax efficient than actively managed mutual funds because they trade less frequently, generating fewer taxable events. Actively managed mutual funds tend to be the least tax efficient because managers buy and sell holdings more frequently, potentially generating capital gains that get passed on to shareholders. However, if you're investing primarily in tax advantaged accounts like 401ks, IRAs, or TFSAs, tax efficiency becomes less important because you're not paying taxes on gains within those accounts anyway. The practical implementation strategy. For most women in their 40s and 50s building wealth for retirement, here's what actually works. If you're just starting, begin with broad market index funds through your workplace retirement plan, or a simple 3 fund portfolio: total stock markets, international stocks, bonds, using low cost index funds or ETFs. If you want automation, set up automatic monthly investments into index funds. The ability to buy fractional shares makes this easy and helps you dollar cost average over time. If you want flexibility, use ETFs in taxable accounts where you might need access to the money or want to make tactical adjustments to your portfolio. If you want simplicity, choose one broad market index fund or ETF and consistently invest in it. This beats trying to optimize between multiple options while not actually investing. The common mistakes that derail success. Mistake one: paralysis by analysis. Spending months researching the perfect fund while not investing in anything. The difference between a good low cost fund and the perfect fund is tiny. The difference between any fund and no fund is enormous. Mistake two: mixing all three without purpose. Some people buy mutual funds, index funds, and ETFs of the same asset class, thinking they're diversifying. You're just complicating your portfolio and potentially increasing costs. Mistake three: chasing performance. Switching between funds based on recent performance. Last year's best performer is often next year's underperformer. Mistake four: ignoring your investment timeline. Choosing investments based on features you don't need. If you're investing for retirement in 15 years, daily trading flexibility doesn't matter. Here's your next step forward. The most important decision isn't which type of fund to choose. It's to start investing consistently in low cost, diversified funds and stick with the plan. Whether you choose mutual funds, index funds, or ETFs, focus on these key principles. Keep costs low. Maintain broad diversification. Invest regularly and resist the urge to make frequent changes based on market movements. Your investment success won't come from picking the perfect fund structure. It'll come from consistently investing substantial amounts over time in reasonable investments. Understanding the difference between mutual funds, index funds, and ETFs isn't about becoming a financial expert. It's about having enough knowledge to make confident decisions and start building wealth. These aren't fundamentally different types of investments. They're different packages for accessing the same underlying markets. Choose the package that fits your needs, keep costs low, and focus on the investing habits that actually build wealth. The difference between someone who builds substantial retirement wealth and someone who doesn't isn't about choosing the perfect investment vehicle. It's about choosing a reasonable approach and implementing it consistently over time. You don't need to become an expert in every nuance of fund structures. You just need to understand enough to make good decisions and then focus on the behaviors that compound wealth over time. If you found this breakdown helpful and want to keep building your investment knowledge, I have another video that shows you exactly how to prioritize which accounts to fund first when you're ready to start investing. It's the logical next step after understanding your investment options, and it can save you thousands in taxes over time. Because understanding investment vehicles is just the beginning. Knowing how to deploy them strategically, that's where real wealth building happens. See you in the next video.